Hi guys, it's Daniel here, and I want to draw your attention to one stock that's rapidly changed its fundamentals and is actually really underreported. So let's get into it. So the name of the company is Best of the Best, ticker BOTB, and it trades on AIM. So what these guys do is they run car competitions, they run online competitions, the ability to win cash, laptops, holidays, all those kind of things. That's what they do, they run competitions. And in the past, what they've had to do is actually run it out of Heathrow Airport and the like. Obviously, that had really costly overheads, which can now be stripped away, because when you're online, what do you need? You just need like a website, a couple of tech guys. I'm sure there's more to it than that, but it's not as expensive as renting space in a very busy airport. I actually came across this company quite a few years ago, and the margins looked kind of okay. The growth rate was a very average 20% a year. And basically it's doubled its revenues every 5 years or so, but there was nothing previously to write home about. However, with COVID, they've actually pivoted their business completely online, so it's a 100% online model. So how I'm going to structure this video is that I'm going to have some very high level risks and opportunities. And if you haven't got time, you can take those away and do your own research. But if you do have time, we can delve into some of the details as well, a bit of the fundamentals, which is the part that I really enjoy. So just looking at the opportunities here, it's basically an excellent cash generating online platform. It's got amazing financial metrics. We'll look at the GP percentages, the ROCE. It's also got no debt. It's just throwing off cash like crazy. It's also benefiting massively from a COVID tailwind. By that, I mean there's limited sports matches being put on at the moment. So there's limited things to gamble on at the moment, right? So people are stuck at home, and what they're going to do, they're going to drink, they're going to smoke, they're going to gamble, they're going to try and pass the time. I think there's quite a few people sitting at home with money, and actually they want to spend some of it. Perhaps they haven't gone on holiday this year, but you know what, they can go and play online poker. As you know about my channel, I always try and be balanced. I'll never say a share is going to 10x or 20x or something crazy like this. As you know, I always have a balanced approach to investing, and here I'll try to share some of that balance with you by providing you with some risks that are on the table. So the first risk really is because the original family still own about 75% of the listed shares, there's a great deal of illiquidity in those shares. And what you'll find is actually the spread is really big. So if you buy it on one day, you will automatically be 8% down because the spread is about 8%, which is massive even for an AIM share. This illiquidity of shares coupled with a lack of comparisons makes true valuations actually quite difficult. So for example, what PE ratio should you be using? Now, as I said, this company's been throwing off cash like crazy. They've declared actually several special dividends recently, which for a lot of people is really great. But for me, it also suggests that they've got a lack of ideas, a lack of ways to grow the business, or just something is lacking. Because ideally, in an ideal world, right, what you do is you take that cash and 100% push marketing, grow the business, all those things. So there's a little bit of uncertainty why they haven't pushed the business as much as they could have, and instead they're paying out cash to shareholders. So one reason they could be doing this is actually to gain press coverage. They've popped up in Investors Chronicle on January 14th as a result. The last risk is they're actually under potential takeover by private equity. So there's a small but not insignificant risk that management might agree on a price actually lower than what it's trading at now. So what that would mean is you'd make a loss on your investment if you got in now. So as you can see here, you've got the income statement over the last few years, and the revenues have grown leisurely 20% a year, doubling every 5 years or so. But then suddenly what happened this year is it absolutely smashed out of the ballpark. Revenues grew 190%, profit before tax 392%. You've got cash and cash equivalents, of course, going up 200% or more than that. Cash from operations, which is a key number I look at, is up 767%. And they have no debt at all, which is absolutely crazy in a good way. It looks very, very healthy. So as I mentioned, what they do is they allow you to enter car competitions, and actually they've branched out a bit into lifestyle competitions, so winning bikes, cash, holidays, watches, those kind of things. And that's actually really driven the income statement massively up. You've got profit before tax right at the bottom there, about 30% margins. So it's really exciting what it's done. And in previous years, you can see it was like half that. That's probably because they had to pay for really expensive stands in airports. So as we delve into the detail a little bit more, I just want to take you through my 12 criteria for investing. The first 3 are actually, I've just taken them. I've nicked them from Terry Smith. The other 9 I've kind of built up over the years. So the first one we're going to look at is ROCE. So that's return on capital employed. So basically asking the question, are we really sweating the assets of the business? So for example, that's going to be really great because they're online, they don't have many overheads. If you've got a business, for example, like a construction business, a mining business, you've got to buy drills, you've got to spend money on maintenance, and that's all before you've even dug anything into the ground, so your ROCE is going to be really poor there. So as a guide, Domino's tends to be about 40 to 60% ROCE. Terry Smith says he would not invest in anything with a ROCE less than 15%, and we're pumping out 188% for BOTB. The next one is a profit to cash ratio. So Terry Smith really likes companies where profits rise in cash, so 90% or more, so that you can pay the rent, they can pay dividends, things like that. And we're pumping out at 121%. The third thing that Terry Smith really looks for is, repeat transactions. He doesn't like one-off transactions. For example, if you're building a tunnel and if you don't build that tunnel correctly, the company's going to go bust. He hates that kind of thing. He likes everyday, repeatable, predictable transactions. And of course, gambling pretty much is, right? What I would add to that is during the lockdown, there's actually very few things you can gamble on. So there's poker, but in terms of sports betting, that's quite limited actually. So the first of the criteria that I personally look for is a strong cash from operations increase year on year. So cash from operations has increased by 767%. Actually, another thing I look for is strong sales growth over the last 3 years if applicable. But here, actually, the company's pivoted. So in 1 year, they've grown 190%. And I'm not too worried about the previous years because, online has branched them out a lot. They're finding a lot more, Facebook users, Instagram users. I'll put down here somewhere how many users they have. I also look at who else is investing. So is the smart money like BlackRock or JP Morgan in on it? And actually it's quite liquid. So this is a bit of a negative. The family are still kind of basically controlling this company. The next of the investing criteria, number 7, is actually a favorite of Warren Buffett. So this is about a strategic moat. Does it have a strong brand, a strong design? Here I'd actually argue yes, because they've been going for 20 years. That it's a legitimate competition. It's not something that's, made up and only their friends win. It's a credible brand. Another thing I look for is a really strong gross profit, about 30% or more, with OP in double figures. Actually, this is the profit before tax, so several layers down from the gross profit, and it's still at 30.8%. The next thing I look for is a good outlook from the broker or brokers that cover this stock, but actually this plays to our advantage. It's not updated, it's been massively underreported, and I don't think that they haven't caught on yet basically. I also look for low capex for that sector, and yes, because they're online, it does have a low capex. That's capital expenditure, so they're not needing to buy heavy machinery or equipment to operate. They don't even need to buy shops, they don't have any shops. It's just a pure online play. Number 11 of my investing criteria is to ask, is it priced correctly? Now this is really hard to gauge, basically because of the liquidity. Also, it's undergoing potential offers of a takeover, so it's actually really hard to price actually, and that's the risk of this. And lastly, any other business, there's no debt, so it's a massive cash cow. It's growing as well, which is incredible. I think the only difficulty is actually on the price. Obviously, I don't want you to think I'm just making numbers up and shoving it on Excel. So I've enclosed a copy of the trading update that was published recently. So let me know if that was useful or not. Hopefully that gave you a bit of insight into how I formulate my investment criteria. And let me know what you think about this stock. As a bonus, just to let you know, Investors Chronicle recently published an article on the stock and they have a hold rating on it. As I've said, I'm Dan, thank you for your time, and as a second bonus, I'll let you look out my window at the snow. It's amazing. And they have a buy, no, blah.